How we doing? Today is Tuesday, April the 2nd, 2024. I am just doing this presentation here in regards to real estate notes and real estate note investing. The goal of this presentation is to show you a way that you can invest your retirement money and or investment capital to get a higher rate of return more safely and securely backed by real estate. So I'm going to share my screen here and kind of go through this presentation. So as you can see, this is, that is my email address and my contact information. And essentially, this is a private money presentation. We're looking to educate people in regards to what can be done with private money, whether it's through your retirement account or if you just have money somewhere in another account or money that you're looking to get a higher rate of return. We're going to go through this presentation and show you some ways that you can do that and how we try to structure things to protect you and to also have your money grow more safely and securely. So a little bit about me. I graduated Rutgers, New Brunswick, that's in New Jersey, back in 2000. Was a licensed real estate agent for over 20 years in Essex County, New Jersey. I have worked with different banks to help them with their REO and short sale inventory, Bank of America, Wells Fargo, and a few other banks over the course of my career. Obviously listed a number of properties. I also worked in the rental market as well. So we've done, worked with buyers as well as sellers as well. I have some experience in construction. I was a field supervisor on a construction development back in the late 2000s, early 2000s for about 3 years. We managed that particular site and made sure that it got up and running. Also, I also was in insurance. I was an insurance agent, property and casualty insurance with State Farm. And I'm not an agent anymore, but do have that experience as well. So been around real estate and real estate related activities for a long time. So again, we're here to offer higher rates of return to individuals with investment or retirement capital, safely and security backed by real estate. And we're going to do that through buying, selling, and creating real estate notes. And we'll get into exactly what that is as we go through the presentation. So we look to use private financing to acquire single-family real estate and create affordable housing by offering financing to aspiring homeowners. Again, we create, buy, and sell real estate notes. We act, think, and operate like a bank. So that's the purpose of this, as well as to get you to act, think, and operate like a bank with your own money. Become your own bank by creating, buying, and selling of real estate notes. So what is a promissory note? Promissory note provides the financial details of the loan's repayment, such as the interest rate, length of term, and method of payment. It's better known as an IOU. So it's going to, spell out these things in that promissory note on how you're going to get paid back for the loan that you make. Some instances, you don't actually have to take money and create the loan. You can create the loan just by creating the paper and having it as a lien against the property. So creating a note can happen, in more than one way. It doesn't necessarily take you actually physically giving someone a loan. It can be structured just through the paperwork. So what types of deals do we look to do? And we look to present to our uh, lenders, our private money lenders. We look to purchase single-family homes under $400,000 from either distressed, low equity sellers and traditional sellers in non-judicial states. The reason why we choose non-judicial states is because if there is any type of issue with the person that's in the property or living in the property that can't pay, there's a shorter time frame to get the property back, either through through foreclosure or a couple of other different means. So that's what we look to do. We try to stay in what is considered nationally the median home price. Obviously, you have some markets where the median home price is considerably less, and then you have some markets that the median home price is considerably more. But in the areas in these non-judicial states that we try to focus on, primarily in the Texas area, we want to stay, under this $400,000 because of the affordability issue as well. We want to make it so when we create these notes and for the homeowners that are in there, that they won't have a big problem or won't be over and above what it is for that particular area for them to make that payment. The properties that we do will require minor or no repairs. We try to make, do the deals, I should say, that they are, you can move in tomorrow and just live in the property. You may want to do some minor touch up here and there, some paint, something like that, but really, really minimal, if no work at all. Once the property is acquired, we then identify a qualified buyer to put into the property. So we're creating the financing for the individual to move in to the property. We want to create more homeowners. We're not in the business of creating renters. We want people to own their home, take pride in their home, build neighborhoods, and for them to build their own wealth through home ownership. And that is ultimately, what we want to do for our buyers. And so we locate these people a number of different ways. And for whatever reason, they're not able to get the financing from a traditional bank. It could be the way that they make money. It could be maybe they had some type of issue in the past with their credit or something happened in the past, but they're not able to go down to a lending institution and get pre-approved for a loan. So we have a wider buyer's pool than other people who are trying to sell, who are just looking for those that are getting a mortgage. We will look for those that do get qualified for mortgages and for whatever reason aren't, haven't purchased a home, but we're also looking for those that may, have some issues and can't necessarily purchase at this particular time or get qualified, I should say, at this particular time. So that's who our buyer, will tend to be. So the promissory note, as we talked about earlier, it goes together with a security agreement. So what secures you to the property is this security agreement saying that it's basically pledging the property as the collateral for the promissory note that you make. So if somebody cannot adhere to that IOU or to those terms that were set up in the promissory note, the security agreement is what you use to enforce that promissory note. So, and that pledges the property as collateral. So if you cannot, that person cannot make that payment, you have the right to then go ahead and get the property back. So those two things to go together. And these are things that we do to protect our lenders. These are the types of documents and agreements that we have in place that will protect anybody that wants to lend money on the deals that we do. Also, we have lender is an additional named insured on the policy. So if something does happen, if there's a fire, some type of, serious damage done to the property, the lender is protected with the lender's insurance policy. So you know that, any money that you put into the particular deal, it is covered through the insurance. We have a lender's title policy. That's where the insurance protects your lender against problems with the title to the property. So if there was a mistake made during this particular process, if the title company missed something, didn't pay something off, something comes back down the line, 4, 5, 10 years down the line, you're protected through your lender's title policy. So we get both. We get the lender's policy to protect our lender, and then we also get a policy for ourselves as the investor. We also do a confession of judgment, meaning that if for whatever reason we cannot continue to make the payment, we're not going to make our lender go through a long foreclosure process to get the property back. So we've already signed over this particular property with a confession of judgment saying that, hey, if I can't do what I said I was going to do after 90 days, this house automatically goes back to you, and then you have the right to then go ahead and sell the property or do what you wish with it at that particular time. And then also our underwriting process for our new homeowner. We don't take low down payments like FHA and other programs that are out there. We look for those people that are making good enough income, have enough money saved up. We require at least 8% down typically. We'll do 10% or more for these particular homeowners. So they have something significantly, they put down some money and they're invested in this particular property. So if somebody has put down, let's just say on a $300,000 house, anywhere between $25,000 to $30,000, it's going to make it pretty difficult for them just to stop making payments and walk away from the property because they have skin in the game, what they call skin in the game. So we look for that anywhere from 8% or more down in terms of a down payment. And then what we also do is get them qualified through a residential mortgage loan officer, RMLO for short. Um, so we get them qualified just like a bank would. We want to see their financials. We want them to prove how much money in the bank. Where's this down payment coming from? What is your job? Where have you been working? What is your job history? Are there multiple um, are there multiple people in the household that are working? So we have our loan officer go through that particular process, and we try to make sure that they're not making more than 40% of their payment towards the mortgage, because obviously, if you get over and above that, closer to 50%, if something goes wrong in your life, or with another part of your life, you have a car payment, a medical bill, or something like that happens, then the likelihood of you missing a payment on your mortgage is greater if that percentage of your income is higher than 40% going to your mortgage or your home payment. So we make sure that we keep them, at or around that 40%. And this way, combined with the down payment and knowing that, they're spending less than 40% on their housing, the rate of default or the chances of them going into default, are reduced considerably. And so here is an example. I'm just going to play this video here. This is an example of a deal where we create the financing for a potential buyer on a home. And we're just going to walk through this and watch this video really quickly. How you doing? We're just going to take a few moments here and go through an example of a deal and how we structure it, what the deal looks like, how the numbers play out. So we're just going to walk you through that process as a part of this presentation. So here is the property address. This one is in Jarrell, Texas. Most of the time we focus on states like Texas because they are non-judicial states, meaning that the foreclosure process, if and when we have to do that, takes a lot less time to execute as opposed to a judicial state where things can get extended for months and even years at a time. So this property is in Jarrell, Texas. Here is the address. I'll show you the photos of this particular property. So as you can see, it is move-in ready. We, look to purchase, properties like this that don't need a lot of rehab or any at all. That's the exterior. You saw some of the interior photos. So it's very clean, move-in ready. Someone can just, move in and live in this property right away. So here is, how the numbers break down. So we just put a slight little estimate of rehab. I mean, if we want to go in there and do something, we really don't need to do anything. But when we evaluate these deals, we try to always, add in some costs, add in some things like that so we can protect ourselves on the back end. The as-is value looks to be about 337,000. We can take you here over to where they have an estimation. As you can see here, this is what some of the values that the properties, have on the high side, 375, and on the lower side, just above 325,000. So we feel like we can be somewhere in the middle of that, especially when we are creating the financing for the end buyer. We feel that this number will come in good as to what properties are worth in this particular area. So for this particular deal, we would be taking it over subject to, meaning that there is a pre-existing lien on the property that'll be in first position. And the person that funds this particular deal or deals such as this are going to be in second position. So here is the unpaid balance right now. We have some other costs that go along with this. There's a realtor involved. We were brought this deal by a wholesaler. So they have to get paid for bringing us the deal. And this is the unpaid balance and the principal and interest payment. I think, for this particular example, it's, off a few cents, but for numbers purposes, we can, see how this thing comes together. So the payment, total payment is just about $2,775 and principal and interest $1,278. And what makes this deal so attractive in deals like this is the interest rate. As you can see here, 2.37% interest rate is what the underlying mortgage is. And it has about 329 months. So when we purchase these properties and we create financing for someone else, we're going to be creating it at a higher price with a higher interest rate and be able to collect the difference in the spread there. And that's why these deals, are so worthwhile, because they last, over time. They last for, over 25 years. Usually they don't go that long. They go somewhere between 8 to 10 years, but we have 329 more months left on this particular loan. It will pay down at this interest rate. And so we do is sell this property at about $340,000. And again, when we sell these properties and we offer terms to our buyer, we make them put down anywhere between 8 to 10%. For this example here, we're going to say that they're going to put down at least 10%. And then what we're going to do is create 2 mortgages for our buyer. They're going to be behind the first lien that we talked about and the lien for the person that's funding the deal. So we make sure that our funders get paid before we receive any money on these particular deals. We want to make sure that the funder is protected at all times and make sure that they get paid before we make any money. So what we're going to do is we're going to write, in this instance, to be a third and fourth position lien on the property at $255,000. And for modeling purposes here, we did about 9.5% interest rate. We may be able to go a little bit more, but again, we want to be a little conservative here. And if the numbers work out at 9.7, if we're able to locate a buyer that can maybe afford a 9.75 or 10% interest rate, that just adds more to the deal in the end. And we're going to do 360 months, and this is the payment, just under $2,145. And then we're going to do another loan that'll go in fourth position at 9.5% for 360 months. And you'll see the payment there. And so what we'd be looking for on the funding side is roughly $48,000 to be able to take down this deal and pay all the closing costs, pay all the people involved that brought us the deal, and make sure that they're taken care of. We'll need about $48,000. And we're willing to pay up to 18% interest on this for 60 months. This would be what we would take home as the person that's orchestrating the deal and managing the deal per month. And then this would be the payment, the $1,218.88 would go to the funder each month for the next 60 months. And so, even with paying a wholesaler, paying a realtor, and all the costs that go into this particular deal, we can still come out on the positive side and cash flow this deal, paying up to 18%. Obviously, if we can negotiate this to a lower interest rate, it works out better for us. Or the other option too is that we can just split the overall cash flow evenly, and the funder can stay in the deal longer, past this 5-year period, can stay in it for the 329 months, or whenever there's a liquidity event where the property, either person that's living in it, the homeowner, sells the property or maybe wants to refinance or something like that, there'll be a certain amount of cash owed to us because we are creating financing over and above what is the underlying loan. So there'll be a difference there, and we can split that, and we can talk about the percentages on that split as well. And so you might say, well, why would we want to do a deal where we're only making $76.14 a month? The reason is because there's going to be a liquidity event down the road. And these deals a lot of times run, like I said, about 8 to 10 years. So in 100 months, if there was a payoff, we would have collected over $114,000 in total profit. And that's after, that's including what the funder getting paid off in the 60 months. Or if you want to do a equity split, we'll be splitting, $114,500 if and when this property sells in 100 months. Obviously, if it goes longer than that, let's say it goes 120 months, the total profit just continues to go up. And that's what we're really looking for, is to kind of put these things in our portfolio for later on when they pay off. We try to, get as many of these as we can. So in, 8 to 10 years, we'll start to see some of these payoffs down the line. So that's just an example of how we do the deals, how we structure the deals, and why they make sense for us and they make sense for a funder. Because again, we can pay up to 18% interest on this particular deal for 60 months, or do some type of equity split on this. So that's just an example of the deal, like I said, that we wanted to share for this presentation. Hopefully it made sense to you. And if you have any questions, please let us know. And so that's just, one way that we structure deals, is by doing them that way, where we take over a loan subject to, and then we create financing for a end buyer, who's going to live in the home, moving forward. And we're just, in the middle of that deal and managing the deal from being, in the middle. So, there are other deals out there that can be structured and can be done. This is just one example for this presentation, and one that, that we can do very often. Right now, we're seeing a lot of these deals come across our desk. They come up pretty frequently, especially in this Texas market. So what are the risks for the private lender? Well, obviously, the biggest risk is a homeowner default. Or in our case, if something were to happen to us, the one that is responsible for paying you, what happens in that case? So if there is a default by the homeowner, what we can do, because we talked about earlier with that confession of judgment, we have our homeowner sign as well, is that we can get the property back. We don't have to most likely go through any type of extended foreclosure, where it's going to take months and months and months. We can, pretty much reach out to this person, then that document, the confession of judgment, we can file that and make sure that we can get the property back in a timely fashion. And then what we'll do is we'll find another person that we can kind of create this financing for again, and get another significant down payment when that person does that. And when they do that, we can actually get our funder most likely paid off sooner rather than later. But like we mentioned before, the probability of a default, it would have to be something significant that happened in someone's life. Life happens to everybody, so we can't say that there's no risk of somebody going into the default. But again, if somebody has put down $25,000, $30,000 in terms of a down payment, them just stop making their payment for no reason, trying to extend a foreclosure and live in a house for free is very rare, to say the least. So we would definitely get this person out of the property, begin to market for another person to put into the property, create the financing for. There are also some other options if for whatever reason we couldn't find someone that we could get qualified as the homeowner to go on the property. We still have the ability to possibly do a lease option. We could do it as potentially a rental as well, to get someone in there. We could do that as well. So we have a couple of different, options in terms of if and when there is a default. So, and that's probably one of the biggest risks that, that you have to think about when funding a deal like this. Also with this, there's a due on sale clause that could happen. The due on sale clause happens when someone who owns a property that has that mortgage that we talked about, that first lien mortgage, and they wind up selling the property, the lender in that first position can call the balance of the loan due. Now, this is not something that typically happens. It happens probably in less than 10% of all the transactions like this that go on. But again, when we're talking about risk, we have to, talk about the risks that are out there and what could potentially happen. The way that we protect ourselves is through how we do the paperwork, do the documentation for this, where the bank really doesn't see any interruption. They don't see any they don't get any missed payments or anything like that. There's no red flags that kind of go up and say, hey, this person sold the property, and now we want to call the loan due, because they really don't want that either. They want to collect the payments. The banks are in the business of making loans and collecting payments with that interest rate. That's what they want to do. They really don't want to take the property back, but there's always a chance that could be done. And then also, even if we do the paperwork properly and we're able to get this thing transferred over into our name now that we're the new owners, if this still comes up at that particular time, this is why another reason why we structure the two notes for our buyer, because what we can then do is take the third and the fourth lien and sell them to make sure that we can pay off the underlying loan. The proceeds from those two transactions being sold off would take care of that first lien, that first lien that is that's being called due. By selling that third and fourth lien, it would be enough money to get that first position lien paid off. And then now we don't have to worry about that anymore. The person that funded the deal, they'd still be in second position, because we would have sold our third and fourth position. So now that person is gonna, because of the amount of money that they're paying for that lien, they're gonna jump into that first position now and take over the lien that we sold. So I don't want to get too complicated on that, but want to, just address some of the risks that are out there. So if somebody's saying, well, what could go wrong? These are a couple of things that could happen, but we've already prepared for it. We've already be able to handle that if and when that type of situation arises. So, that's all the information that I have for right now. Stop sharing. If you see this presentation and you have any questions, concerns, something that didn't make sense, please reach out. The telephone number is 973-475-8488, or you can send an email to dealsacg@yahoo.com with any questions that you have, and we can either jump on a call or something like that and kind of talk about it. But, we're looking for individuals that want to get that type of return on their money safely and securely, and is backed by real estate. The fact that you're putting your money in second position secured by a 2.37% first lien is pretty safe, because if something happens, God forbid something happened to me, if, I didn't do what I was supposed to do, you would still be able to you still be behind that 2.37 interest rate and be able to collect all the cash flow from the person that's living in there. If I, for whatever reason, didn't do what I was supposed to do and tried to run off with the money, or something happened to me, um, you would be able to collect that payment, would then go directly to you. The full payment that the person is making, would go over to you, and you would still be, protected. So, like I said, if you have any questions, have any concerns, please reach out. Let's talk about it. But these deals are out there. There's a lot of these deals out there. There's more that's probably going to be coming as there's changes in the market. And we just want to be able to take advantage of the opportunity and help people grow their retirement accounts and grow their investment capital. All right. Appreciate it. Everybody have a great day, and we will talk to you soon, hopefully. Have a great day.